Something just snapped in the global macro machine, and cable is sitting on the knife's edge of a structural breakout that could define the next 300 pips. Right now, pound sterling to US dollar is trading at 1.3506, less than 7 pips away from the 1.3513 resistance that has rejected price 4 times in the last 10 sessions. But today is different. Overnight, Iran nuclear deal hopes lit a fuse under crude oil, collapsing the dollar, and every single timeframe on sterling, monthly, weekly, daily, even the 1 hour and the 5 hour, is printing a strong buy signal. There is one danger zone that will vaporize unprepared bulls, and one hidden opportunity that the smart money is already positioning for. I'm going to walk you through both, and if you stay with me to the end, I'll hand you 3 exact entry and exit levels you can act on immediately. Here is your instant market verdict. The session bias is unequivocally bullish continuation. We are not fading this dollar weakness. We are not trying to pick a top. The trend is strong. The moving averages are stacked like an army marching north, and the fundamental catalyst is a fresh dollar sapping shock. The bias shifts only if we get a sustained 4-hour close below one single invalidation level. Write this number down. If cable breaks and closes below 1.3457 on the 4H timeframe, the entire bullish structure collapses. That is the line in the sand. Above it, every dip is a buying opportunity. Below it, this whole analysis is wrong. Store that number in your head, 1.3457. Now let's walk the charts the way I see them on my institutional screens, from the top timeframes down to the execution level. Start with the weekly. The weekly chart has been painting a series of higher lows and higher highs ever since the 1.2000 area back in March. Right now price is pressing against the top of a massive ascending channel, and the fact that the weekly MA20 at 1.3465 is holding as dynamic support tells you that the trend is not just alive, it is accelerating. The weekly MACD is firmly above its signal line, histogram rising, no hint of negative divergence. This is not a market trying to roll over, drop to the daily. Daily trend is strong buy. Look at the moving averages. The MA200 sits way down at 1.3382. That's the anchor. That's the level that would need to be violated to even begin a conversation about a trend reversal, and we are more than 120 pips above it. The MA50 is at 1.3471, the MA20 at 1.3465, the MA10 at 1.3461, and the MA5 at 1.3458. All 4 of these averages are clustered within a 12-pip band, and they are all sloping upward. This is a textbook moving average compression that usually precedes an explosive directional move. The daily MACD is reading -000, basically flat but starting to curl upward from below the zero line. That's early-stage bullish momentum that hasn't even been priced in yet. RSI is at 53, miles away from overbought, so there's plenty of room to run. The key daily resistance is right here at 1.3513, with the next structural barrier at 1.3537. Support is at that 1.3457 zone, backed by 1.3433. Come down to the 4-hour chart and you'll see why 1.3513 is such a battle zone. This level is the neckline of an inverse head and shoulders pattern that has been forming for 2 weeks. The left shoulder formed around the 1.3400 handle, the head dipped to 1.3350, and the right shoulder just completed with a strong bounce off 1.3457. The measured move of this pattern projects directly to 1.3680. That's the prize if we get a clean breakout. On the 4-hour, the MA20 has crossed above the MA60, and both are pointing north. The MACD histogram is printing higher bars above the zero line, and the signal line is on the verge of a bullish crossover. Buyers are absolutely not exhausted here. The momentum is just getting started. What's even more critical is that the 1-hour and 5-hour charts are both strong buy, meaning even the shortest-term algos are aligned with the higher timeframe trend. This kind of multi-timeframe alignment does not happen by accident. It's institutional flow. Now here is what most traders miss. While you're watching cable in isolation, The real signal is screaming from the cross-asset space. Euro to US dollar is up today as well, but GBP is the true dollar killer. Look at euro to pound sterling. It's dropping, piercing below the 0.8600 handle as I speak. That means sterling is not just rallying because the dollar is weak. Sterling is rallying against the euro too. That's pure, idiosyncratic sterling strength, and it changes the calculus completely. When euro to pound sterling falls alongside a cable rally, it's the institutional footprint of a genuine GBP bid, not just a short covering squeeze against the greenback. This is the cross-linkage you must respect. Let's connect the last 24 hours of news directly to the price action, because this is the engine that just ignited the move. Overnight, headlines hit that Iran and Western powers are edging closer to a revived nuclear deal. Immediately, WTI crude got smoked. It plunged more than 3%, but here is the twist. The US dollar index got crushed alongside it. Why? Because an Iran deal eases geopolitical risk premia across the board, reducing safe haven demand for the dollar. At the same time, the oil price crash takes pressure off headline inflation expectations, which the bond market interpreted as a reason for the Federal Reserve to be less aggressive. US yields dipped, the rate hike premium deflated, and the dollar cascaded lower. That double whammy of geopolitical de-escalation and disinflation narrative is rocket fuel for cable. And on top of that, the Bank of England is nowhere near done. UK wage growth data this week was sticky, services inflation remains a furnace, and the market is pricing a terminal rate above 5.75%. Flip over to the ECB. Christine Lagarde sounded visibly cautious in her latest remarks, highlighting growth cracks in the Eurozone, effectively signaling the ECB is at or near its peak. That policy divergence, a hawkish bow against a potentially plateauing ECB, is widening the rate differential in sterling's favor, and it's supercharging every tick higher in pound sterling to US dollar. This is not just a dollar story. This is a sterling strength story. Over the next 1 to 2 weeks, my directional lean is firmly bullish. I am targeting 1.3600 as the first port of call, and then a measured move extension toward 1.3750 if 1.3537 can be convincingly taken out. The thesis invalidates immediately if price breaks below 1.3433 on a daily close, because that would suggest this entire compression is a bull trap and the sellers are taking control. The event risk that could flip the script is a sudden collapse of the Iran deal talks, which would spike oil back up, reignite inflation fears, and send the dollar soaring. But as long as the geopolitical breeze is at our backs and the bow remains the hawkish outlier, the path of least resistance is up. Most people will click away right now, but this is exactly where money is made. Keep watching. I'm about to lay out 3 trade strategies with exact triggers, exact stops, and exact targets. Strategy 1 is what I call the sniper. This is the conservative play for those who want confirmation, not hope. Strategy 2 is the active trader, for those comfortable buying into a dip before the breakout. And strategy 3 is the aggressor, a high-risk momentum chase for the quick-handed. Every level I give you is pulled directly from the technical landscape I just walked you through. Strategy 1, the sniper. We are waiting for a confirmed breakout and a retest. The trigger condition is a clear 4-hour candle close above 1.3513. Not a wick, not a spike, a body close. Once that prints, we wait for price to pull back into the 1.3513 to 1.3500 zone and show a bullish rejection, a pin bar or a bullish engulfing candle on the 15-minute chart. That's your entry confirmation. Set a limit order at 1.3510. Your stop loss goes at 1.3489, which is beneath the 1-hour MA20 and the low of the breakout consolidation node. That's 21 pips of risk. Target 1 is 1.3537, the next key resistance, giving you 27 pips and a risk-reward ratio of roughly 1 to 1.3. Target 2 is the measured move extension at 1.3580, which offers a 1 to 3.3 reward ratio. Once target 1 is hit, move your stop to break even. This setup is voided if cable fails to hold above 1.3457 before the breakout confirmation. This is the sniper's way, high probability, defined risk, no guessing. Let's see how aligned we are as a community. Right now, type your pound sterling to US dollar range for tomorrow's session in the comments. Give me your high and your low. I'm reading them, and I'll feature the most accurate calls in tomorrow's video strategy too, the active trader. This is for those who don't want to wait for the breakout and are willing to buy the dip from the fortress of moving averages. Here's the setup. If price pulls back and tests the support convergence between 1.3460 and 1.3457, and you see a rejection wick on the 1-hour candle, a long lower shadow that shows buyer stepping in, enter long at 1.3465. Your stop loss goes below 1.3433 at 1.3428. That's a 37 pip risk, placing your stop beneath the structural low of the range and the secondary support. Target 1 is the breakout point itself at 1.3513, a 48 pip move and a risk reward of roughly 1 to 1.3. Target 2 is 1.3537, and here's the trailing stop rule. Once target 1 is reached, immediately move your stop to your entry price, making it a risk-free trade. Then let the runner target 2 play out. This strategy leverages the strong buy trend and the moving average cluster acting as a springboard. It gets you in before the breakout, but with a deep enough stop to survive noise. Strategy 3, the aggressor. This is a high-risk, high-octane momentum chase for those who are comfortable losing small and managing risk with a scalpel. The entry condition is a clean 15-minute candle close above 1.3513 with no immediate bearish engulfing on the next candle. Entry is a market order at 1.3520. Once that close prints, stop loss is tight at 1.3495, just beneath the breakout candle's low. That's a 25 pip risk. Target 1 is 1.3550, quick 30 pips. Target 2 is 1.3580, extending the gain. This is only for traders who understand that false breakouts happen and can accept a swift loss if the trap snaps shut. The danger is that the breakout lures you in and immediately reverses. That's why the stop is non-negotiable. Do not widen it, do not hope. If the market is going to punish the breakout chasers, you must be out instantly. A quick risk pulse before we wrap. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact news like UK CPI or US non-farm payrolls. Stops are non-negotiable. The market does not care about your conviction. It cares about your discipline. Here's your close and retention loop. If you take one thing from today's analysis, let it be this. The single most critical level for the next session is 1.3457. As long as that floor holds, the bull run is intact and every dip is a reload opportunity for the push through 1.3513 and beyond to 1.3537 and 1.3580. Lose 1.3457, and the structure resets, potentially filling the air pocket back toward 1.3380. Tomorrow, we get Bank of England Chief Economist Hugh Pill speaking, and US durable goods orders. That combination could deliver the confirmation or the rejection of this breakout. I will be right here breaking it down for you live. If you want the full breakdown on Bitcoin and the S&P 500 divergence, where the risk-asset correlation is showing a dangerous fracture, that video is live now. Click the end screen and continue your market intelligence binge. Smash that like button if this analysis gave you a clear, executable plan. Subscribe, hit the bell, and never miss a day of institutional-grade intelligence. I'll see you in the next one.